Yesterday, I was thinking about why we buy a stock, what determines our behavior to buy a stock, and why is it wrong? Well, here's why I think it's wrong. We buy stocks, retail investors, because the earnings per share, the revenue increases or decreases. And then we look at what the company does. Oh, this is wonderful. They're building, they're a nuclear power company, and they're, these data centers need power, and this is one of the most efficient ways of powering this, that, and the other. And yet they don't go anywhere, right? And I got to thinking deeper about this, and I was like, Cisco came out with earnings last night, and their earnings were good, right? But their guidance was positive. We're gonna do better next quarter. We're gonna do better next quarter. Here's where we see ourselves fitting in the next, say, 12 months. And the market's up on Cisco. And I was thinking about that, and I'm like, that's very interesting, because it isn't based on numbers, it's based on guidance. And the stock's going up. Now, CoreWeave, that's a company did well, but they guided a bit lower, and the market rewarded them for guiding lower by sinking their stock price. And they're starting to look at, we don't look at what they're doing debt-wise typically as retail investors. We don't look at the fact they're issuing bonds, and their credit default swaps are astronomically expensive right now, and they've gone through the roof. The rate of change has gone through the roof. We don't look at those things. We base it on this old school of earnings per share and revenue growth. Whereas the guy or gal or the company that when you buy a stock or sell a stock, they are the ones who make a market for your pricing. And they determine what the price will be, the bid or ask price, the bid or ask. And they then hedge that position, because their number one goal is not to lose money. Your number one goal is to make a ton of money, to pay for your kids' college education, pay your house off, to be rich, to go buy a Lambo, blah, blah, blah. Now, these are guys who are guys and gals or institutions, which refer to them as institutions. They make a market for you and I. And they determine the value of a stock on a very, very short-term basis, but every day they determine what that stock is worth. And then they protect themselves. They hedge against it. Because if they lose money, they lose their seat on the CBOE or on the New York Stock Exchange or the NASDAQ. And they pay millions of dollars for those seats to be market makers. And there is an enormous amount of money to be made as a market maker. Citadel, prime example, one of the largest market makers in the world, started out as a hedge fund out of a dorm room at Harvard. And now it's one of the largest market makers. They make their money between the bid and ask price, the spread. So they position themselves to protect their investment, number one. Number two, the volatility of their overall risk and portfolio, and they use options or derivatives to do this. And so when they sell you a stock or they buy a stock from you, they are looking at how much am I going to lose today on this? And they position, and they have this underlying read of how all the other institutions are pricing a stock or the direction. And if we would just, as retail investors, discard this old school fundamental look at stocks and the values of them, but start to look at what the market, the institution, is pricing that stock at and what they're positioning in those portfolios. Prime example, NVIDIA. NVIDIA is fighting to get above $195 a share. And when you pull up the option call wall and put wall, which I review Monday through Friday on the Morning Edge, 7:30 Central, 8:30 Eastern, you notice that they're hedging is getting tighter and tighter. There is less upside to their hedging than there is downside. There's more downside. Their downside hedge is $175 a share. It isn't astronomically 350 like some of these people are, these analysts are gauging. So when you're looking at this market, take a different perspective. You put yourself in the position of a market maker. You transact millions upon billions of dollars a day in transactions. You buy to sell stock to a retail investor or institution. You sell stock to buy, to be able to sell to a buyer, kind of thing. And so if you start looking at the market that way, you can get a better idea what the pricing and the sentiment of the market, the institutions, and they are the market, of what a stock's going to do. And right now I look at NVIDIA and the market's saying, I don't know. The institutions say, I don't know. They know something because their hedging is getting higher highs and more lower lows. Think about it. Have a great day. Subscribe to the Best U.S. Investors. I hope you're doing wonderful and I hope you're making a lot of money. But more importantly, I hope you're preserving your wealth and capital that you've worked so hard for. Learn how to do that by subscribing to the Best of U.S. Investors. Hit the link in the profile. Give us a try for 14 days for free. And then it's $60 after that. But if you risk manage and think like a market maker, chances are you will make more money than that $60 a month. Hit the like button, subscribe button, leave a comment. Live loud. Peace.